Thank you, Don. Good afternoon, shareholders, stakeholders, friends. Despite a challenging environment, as Don said, in 2017, your company delivered growth in both revenue and profits as we continued to focus on delivering consumer and shareholder value. So I want to give you a little more insight, a little more details into the revenue growth and the profit growth that we experienced for 2017, and I'll also share with you a bit on the first quarter for 2018. So as Don indicated, revenue was up 4.8% or $4.2 billion, totaling $92.5 billion. Our net profits were up just over 5% or $237 million, reaching $4.8 billion, with our profit attributable to shareholders growing just under 3%. Now you'll note that while our net profit grew, our operating profit and our pre-tax profit declined. And there are a number of factors, Don touched on a number of them. There were some non-recurring gains which happened in 2016, also some in 2017, but on a pre-tax basis, the non-recurring gains in 2016 were meaningfully higher than those in 2017. We also had the impact of the two major hurricanes that Don spoke about, Hurricanes Irma and Maria. And I'll give you a little more detail on these factors in a short while. But when you adjust for those, our pre-tax profits would actually have just been flat, up 1%, and our after-tax up 9%. And as you can see, that would have also impacted our net profit margins, which were effectively flat, 5.1% versus 5.2%. We continue to grow our asset base. Our assets increased by $3.5 billion, 2.8%, to just under $130 billion. The group's equity position continues to be strong, growing by $3.2 billion, reaching over $45 billion. Now, with shareholders' equity growing faster than our profits, you saw a slight dip in the ROE below the 10% mark to 9.4%. As I said, there were some reasons there that I want to give you a little more information on. So in 2016, you will recall that we had spoken about some liquidation gains that were realized on the liquidation of non-operating subsidiaries. These numbers are after tax, but on a pre-tax basis, this number is closer to $600 million. So you'll see that on a pre-tax basis, the non-recurring gains would have been a lot more significant than the non-recurring gains in 2017. In 2017, we also had some liquidation gains, but as you can see, that was not significant. So after adjusting for the liquidation gains, our profits would have actually been up 15%. But there was also a very significant non-recurring gain in 2017, one that we are pleased with because this has to do with the acquisition of Consumer Brands Limited. And on that acquisition, we booked a gain of $418 million. To explain how this gain comes about, it is realized because the value of the intangible assets that we have acquired, and those intangible assets are the supplier relationships we acquired with the business and the customer relationships we acquired with the business, exceeds the premium that we paid above the book value of the company. In more simple terms, it means the expected future cash flows from this business exceeds the amount we paid for the business. Therefore, we see this as growing shareholder value. And so this is actually an acquisition that so far has in fact been overachieving our expectations, so we continue to be pleased with the performance of Consumer Brands. Other significant events, Don spoke to the hurricanes and the temporary suspension of the remittance locations for our money services business. We remain firmly of the view that while this will have a short-term impact on profits in terms of our investment in compliance, we are ensuring the protection of our customers' money, and we know that this will benefit us in the long term for the business. So we know there will be a short-term impact, but the medium term, we expect to see good growth for this business, especially as we transition to the digital world, and Don spoke to you about woo.com. Don also mentioned the temporary ban on corned beef, over $500 million reduction in revenue, but it's really highlighted the resilience of our food portfolio because products such as Vienna's, mackerel, frankfurters, and ketchup all saw their numbers delivering growth in the high teens, and therefore the overall food division saw growth notwithstanding the decline in corned beef sales. We also had some positive effects, the Jamaica Urban Renewal Tax Relief Act, and I want to go into this in a bit of detail because it has had a meaningful impact on these results, and it's going to continue to have an impact on the business, a positive impact. So as you all know, your company was born in downtown Kingston in 1922, and we have been committed to downtown and its redevelopment for 96 years. So in line with that commitment, we have decided and are in the process of investing over $3 billion in constructing our new corporate headquarters. In addition to it being a beautiful building that will add to downtown Kingston, there are also some very important financial benefits to the GraceKennedy Group in doing this development. One of them is that we currently have subsidiaries that are in New Kingston paying a much higher US dollar rental. They will vacate those spaces and they will be in the new corporate headquarters where we'll eliminate that high-cost US dollar rental. But even more importantly, there are a number of benefits under Jamaica's Urban Renewal Tax Relief Act. And there are three ways in which the Urban Renewal Tax Relief Act benefits the group. Firstly, we get a third of the eligible capital investment. So whatever we invest in this building, whatever has been approved as invested in this building, a third of it we will actually get back in the form of tax credits. Approximately halfway through the eligible capital investment for 2017, and we already recognized $416 million in the 2017 results. As we complete the construction this year, we will be recognizing significant tax credits again in 2018. So this is a meaningful benefit to the group. The other way it benefits us is that we are able to borrow to do the building on a tax-free basis for those who lend the money. That means we can lower the cost of funding for the construction of the building. And finally, any rental income that is generated by the building will be tax-free until 2026. While the majority of the building is going to be occupied by GraceKennedy, there are some retail spaces that will be used, so that rental income will be tax-free until 2026. So again, there are some meaningful benefits to the group. So what did that mean in terms of segment results overall for the group? Our revenue growth, the largest contributor to our revenue growth was our food segment, contributing $3.8 billion of the $4.2 billion in growth that we saw for the year. And Jamaica, we saw growing at 7%, while our international food markets grew at just under 4.5%. As I mentioned, we are pleased with the acquisition of Consumer Brands, which contributed to the growth in Jamaica, as it brought with it the strong line of Procter & Gamble products, and in just 4 months, delivered over $877 million in revenue. We also got good contribution to revenue from our high-low food stores, and this is notwithstanding what Don mentioned, that the Barbican store, which is one of our major stores, was down because of the roadworks. We still saw increased revenue from high-low overall. And in fact, with the new road arrangements that are in place, our director, Paris Liawayi, has assured us that we're actually going to get more traffic passing by high-low Paris. So we actually expect that this will be beneficial for the group going forward. We also had Portmore, which was down because of the renovation, but our experience has been that these renovations have worked well for us. You know that we have been on a process over the last few years of renovating our high-low stores, and after renovation, we certainly see the benefit of that. Also, our addition of other principal brands, such as Lucozade, contributed meaningful to revenue growth in Jamaica. We intend to keep the growth momentum going. Those of you who would have seen our Flavor with a Beat promotion, you will know that it is a very exciting promotion. We expect that to continue to drive growth for us in both our Jamaican and international markets. On the international scene, our USA business did well in terms of revenue growth. In fact, as a single business unit in our international market, it contributed the most to revenue growth, delivering 8% growth with both the Grace and the Lafayette brands growing revenue. Our Canadian food business also continued to do very well, up 12% revenue with good growth in key chains like Walmart, Loblaws, and also securing new listings in Costco. The exception on our international side was our UK food business, where we saw the UK food revenues down 1.5%. That was primarily due to lower sales of nourishment, which is our milk-based drink. On the banking and investment side, we're seeing revenues up just over 7%, 7.1%. And that was led primarily by First Global Bank, which had year-over-year growth of its loan portfolio of about 6.5%, and also significant increases in the gain on sale of securities. We continue, as Don mentioned, our financial inclusion push. And with the opening of FGB MoneyLink mini branches, we will see increased access and convenience to a wider range of customers. And therefore, this will continue to drive the growth for the bank. On our insurance side, the revenues were pretty flat, just 0.2% up. And that was largely impacted by premium rates in the industry. And this was an industry-wide issue where premium rates had become very low. However, we have already started to see meaningful increases and hardening of rates with the recent unfortunate hurricanes in the region that is having the effect. And so you're going to see that when I show the Q1 2018 results, you're starting to see the impact of that. Outside of Jamaica, we continue to grow our regional insurance business, and we're pleased with double-digit growth in our St. Lucian underwriter, GK Insurance Eastern Caribbean, which expanded into St. Vincent. And the money services was the only division, also flat, slightly declining, and we spoke to that earlier in terms of the various compliance measures that we're taking. What did that mean for profits by segment? We saw growth in 3 of our 4 segments, growth in profits. The only segment that declined was the insurance segment, which again has been explained by the hurricanes, Irma and Maria. The other segments experienced growth. 17% growth for our foods division, which was a combination of the revenue growth, which I spoke about, and also effective management of expenses, which was reflected in improved operating margins. Also, of course, the CBL, which has also added to profitability, delivering $82 million in profits for the 4 months. The banking and investment segments, meaningful increase, significant increase, 79%. That was both a combination of the revenue as well as a meaningful decline in our provision for credit losses. And the focus on credit losses continues to be very tight and very strong as a focus for the FGB team. So overall, we saw a reasonably good performance for our profits for the year 2017. And that has left our financial position strong for the group. Our total assets, as I mentioned, grew by 2.8%. That was primarily reflective of our growth in receivables due to the insurance recoverables, because we have this strong reinsurance program that Don mentioned. So we'd have insurance recoverables that we would be gaining as we pay out to our customers. And also, we would have increased our receivables because we would have acquired consumer brands and they would have come with receivables. Other asset lines, when you look through the financial statements, that increase would have been our loans receivable and our fixed assets, which was primarily due to growth in FGB's loan portfolio, the construction of the corporate headquarters, that would be a fixed asset on the balance sheet, and also the renovation of our high-low stores. On the other hand, we did see some meaningful reductions in some of our asset lines. In particular, you would have noticed a significant reduction in pledged assets. Pledged assets just mean our investment securities that are pledged against repurchase agreements, so pledged or secured against liabilities. And you would see that there's a reduction in those repurchase agreements on the liability side, and therefore you have a corresponding reduction in the need to pledge those assets on the asset side. And that really was because our bank was paying down some of its more high-cost funds and improving their margins. Also on the liability side, we saw a good, strong growth in deposits for the bank, growing just under $3 billion or 9.5%. The group increased its use of debt during the year, moving from 31.5% to 36.5%. As you see, this is still relatively low leverage, and therefore there remains adequate capacity for funding of future growth. So as we have generated these funds, how have we allocated them? How have we invested them? We continue to reinvest in our business for growth, and in 2017, we invested approximately $3 billion in capital expenditure for future growth. That, of course, a meaningful part of that, over $1 billion, would represent the investment in our new corporate offices. But it also has investments such as software and technology investments, over $500 million there. our factory upgrades. We done spoke to the CSO with the Sutherland Group, or upgrades of the Postal Service to accomplish that. All of these to generate future returns for the group. And as you would see, as we spoke to earlier, our return on equity with the items that impacted profits dipped slightly below the 10% to 9.4%. Notwithstanding that, we continue to look to increase our dividends for our shareholders. Over the years, as we have invested in the business for growth, we have also continued to grow dividends to you, our shareholders. So in 2017, our dividend per share was $1.13, up from $1.02 in 2016. This is an increase of 11%. And as you see, that meant $1.1 billion paid out in dividends versus $1 billion in 2016. Shareholders this month would have received a dividend of 40 cents per stock unit. And when you compare that to the same dividend declared at this time and paid at this time last year, that would have been a 33% increase in the dividend per share. We have recognized that with the increase in the stock price, if you look over the last few years, and Don would have showed it in his slides, the stock price has increased meaningfully. And that means it has impacted the dividend yield. So the dividend yield would have come down as our stock price increases. And therefore, we're adjusting our dividend payout ratio to take account of that increase in the stock price. And so you would have seen that 33% increase in your dividend paid this month. The GraceKennedy stock price closed the year at $43.84, up from $40.29 at the beginning of 2017. So that represented a 9% increase. So in addition to the dividend yield, there was also an increase in shareholder value. And when we look at it, as Don indicated, and we test it against the multiples that are in the wider industry, then we see that there's meaningful upside for the GraceKennedy stock compared to the market multiples. Using a more recent stock price, we closed yesterday at $48.53, up 11% since the beginning of the year, and outpacing the main index, which is up about 2.5%. So that was 2017. How have we started the first quarter 2018? Before I go into the detailed numbers, a number of you would have been hearing about IFRS 9, and some of you would have been hearing about IFRS 15. And in line with financial reporting standards, we adopted both IFRS 9 and IFRS 15 at the beginning of 2018, as required under the standards. So I wanted to share a bit with you about what that means for the group, having adopted these two new standards. IFRS 9 deals with the accounting for financial instruments, and it affects two main areas: how you classify and how you measure these financial instruments, and also how you deal with the impairment of the financial instruments, the impairment of those assets. Previously, this was covered under IAS 39, and the most common classification there was available for sale, which means that the movements in the value of these assets went through what we call other comprehensive income when they were unrealized, and then got transferred in some cases to the income statements once they were realized. Now, rather than that kind of default assumption of available for sale, you have to test it against a business model or the characteristics of the financial instruments to determine how you will classify these financial instruments. If you are holding these financial instruments just to collect interest and principal, then it will be at amortized cost, not at the fair value through OCI or fair value through P&L. If you are holding to collect interest and principal, but also to sell when it's opportunistic to do so, then you will do fair value through OCI, which is consistent with what we were largely doing with most of our portfolio in the group. So you would have no impact from that. If, on the other hand, you have an active portfolio where you are selling, or your cash flows are not just interest and principal, it may be some type of derivative instrument, then it means you're going to have fair value through P&L. So all the movements in the value of the asset will go through the income statement, which means more volatility in the income statement. On the impairment side, which is where a lot of the discussion has been, what happens there is we're effectively moving to what's called an incurred loss model, moving from an incurred loss model to an expected loss model, an expected credit loss. This means that once you put an asset on your books, you have to start determining how much of this asset you need to provide against it and actually book a provision against those assets. It means you're going to bring forward the credit losses and the impairments to day one. So as soon as you buy a bond, you have to put a provision against that bond. As soon as you disburse a loan, even though the loan is being serviced effectively and there is no indication on the face of it that this loan has been impaired in any way, you need to put a provision against that loan. In fact, even before you book the loan, when you have a loan commitment, you would need to put a provision. And if you add a new customer and you have receivables from that customer, immediately you have to start providing for those potential impairments. The impairment had an adjustment for our equity of $475 million, and the classification and measurement had an adjustment of $288 million. And I'll come back to those numbers shortly. Very quickly, we had IFRS 15 as well, which deals with how and when and how much revenue we recognize from our customers and when we recognize it in the income statement. So now we have certain returns or discounts that we give, and you may be able to, we would predict what those discounts are because we'd have a pattern of giving these discounts, and we'd have to look at those expected returns that might come from the trade, and right away we will have to net that against revenue. Rather than being an expense as it used to be, it will actually be netted against revenue. Those same discounts will then be a liability because it means you're anticipating that somebody is going to come and return these goods, so you'll have a liability to those individuals when they return the goods or when you offer that discount. Also, our customer loyalty programs, where we have third-party suppliers, such as airlines. Many of you would have FGB credit cards, and you're able to use your points with those airlines. It means that when you use those, your credit card and you get those points, we have a liability to the airline, which we will book as a liability. And we won't assume that you won't exercise it. We'll assume that you will utilize those points. And so that will be booked. There's also revenue that you will defer over time. We have always done this with our insurance contracts or insurance premiums. And when you pay a premium today, it's really covered to cover you for the year. So we book that revenue over the year. This is now being applied to other types of deferred income, such as broker commissions. When that commission is paid to the broker also has an obligation in terms of managing any claims settlement that you come in for them. So that commission has to be booked over time. Similar for credit card fees. When you pay a credit card fee, it's for the year. So what has this meant in terms of our financial statements? Overall, the standard gives you the ability, rather than restating prior years, to make the adjustment in your opening equity. And we took that option, and therefore there was a reduction in our opening equity of $900 million. Now, that might sound meaningful, but when our equity is over $45 billion, the truth is that that is very easily absorbed by the group. And going forward, and that really reflects a cumulative effect of this change. Going forward, we'll only be showing, of course, the incremental impact. And in fact, for our first quarter, there was not a material impact on the group of IFRS 9 and 15. Very quickly, in terms of our performance for Q1, we saw revenue growth, as Don indicated, of 5%. Two of our segments were down, money services and banking and investments. Banking and investments was moderately down due to a decline in the FGB loan portfolio, but we're looking for growth this year. Our money services, as we continue to implement the enhanced compliance measures, we will see this impact, as I mentioned, in the short term. On the other hand, our food continued to grow both in Jamaica and in our international markets, and we saw the benefits of CBL continue to be felt, and the momentum of the US and Canada have continued into 2017 first quarter. I mentioned to you that you would see the impact, the turnaround of insurance, and you'll see that insurance is actually up 18%. A combination of the hardening of property rates, but also good growth in both our engineering and motor and special risk portfolios. And then our profit performance. Don mentioned a growth of 15%, 14.9% in after-tax and 6% in pre-tax profits. The difference being the fact that we have continued to recognize the benefit of the Urban Renewal Act. And 3 of our 4 segments showed very strong growth in profits, money services being the declining segment. Insurance had a very good quarter. In addition to the revenue growth, they also managed expenses well. Banking and investments, up 31%, also had a strong quarter. GK Capital Management in particular performed well with a number of successful corporate finance and advisory transactions. While FGB saw a dipping in the revenue because of the loan portfolio, their profit grew as they had lower cost of funds and managed expenses. And then our food group also grew profit 16%, supported both by the revenue growth and improved net margins. So shareholders, stakeholders, friends, we have started with good momentum for Q1, and your team here at GraceKennedy is committed to ensuring that we drive that momentum throughout the year. Thank you very much.